Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to a brand new week. It's Monday the 14th of August. This is Peter Lewis with one of Hong Kong and Singapore's most listened to financial podcasts, Money Talk. And we're the original Money Talk here in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, new lending by Chinese banks fell sharply in July to levels not seen since November 2009. China's banks extended 346 billion yuan, that's about 47.8 billion US dollars, in new yuan loans in July, well below analyst forecasts of 800 billion. And it was a sharp drop from 679 billion yuan a year earlier and 3.1 trillion yuan in June. The data adds to a series of bleak economic readings showing further evidence of a lackluster economic recovery in China. US wholesale inflation rose more than expected in July as prices for services jumped, in a sign the Federal Reserve has more work to do to combat sticky inflation. Annual producer price inflation accelerated to 0.8% in July from 0.2% in the previous month. The reading was marginally above the median forecast of economists, and on a monthly basis, the producer price index, which is a leading indicator of consumer price inflation, increased 0.3% last month after a downwardly revised flat reading in June, and that was the biggest rise since January. The Hong Kong government has revised down its economic growth forecast for this year after data released Friday confirmed GDP grew 1.5% in the April to June period from a year earlier. Growth slowed from a 2.9% rise in the previous quarter. And on a quarter-on-quarter basis, GDP contracted 1.3%, and the economy is now expected to expand in a range of 4 to 5% in 2023, compared with a previous prediction of 3.5% to 5.5%, the Census and Statistics Department said Friday. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and Lashar, Asia Chief Economist at BBVA. Providing a view from Mainland China will be Shanghai-based independent economist Andy Sher. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
The US stock slipped on Friday after producer price inflation came in above market expectations. The S&P 500 closed 0.1% lower at 4,464 and was down 0.33% for the week. The tech-focused Nasdaq Composite fell 0.7% to 13,645. Over the 5 trading days, it lost almost 2%. The Dow was the only one of the 3 major indices to end the day and the week higher, thanks in part to rallies in Disney and Amgen shares. It climbed 105 points, or 0.33%, to 35,281, and for the week it was up 0.6%. Nvidia was the big loser in the S&P 500 and the Nasdaq, down 8.6% on the week. That's its biggest weekly loss since September 2022. The yield on the US 10-year Treasury note is approaching the 9-month high of 4.19%, touched on August the 3rd, as new economic data pushed back against previous hopes of disinflation in the US economy. The 10-year note added 5 basis points to 4.16%, and for the week it was up 12 basis points. The US dollar index gained around 0.33% to its highest level in 5 weeks. The yen briefly eclipsed the 145 figure Friday before settling 0.2% lower at 144.96 yen to the US dollar. The Chinese yuan fell 0.9% over the week in Shanghai to 7.2367 renminbi following weak inflation and trade reports. Oil prices rose for a 7th consecutive week as global demand hit a record high. Brent crude, the international benchmark, traded near a 7-month high of $86.81 a barrel. Chinese stocks fell sharply on Friday. The Shanghai Composite slumped 65 points, or 2%, to end at 3,189. For the week, it tumbled 3%. In Hong Kong, the Hang Seng slipped 173 points, or 0.9%, to finish at 19,075 on Friday. It dropped 2.4% for the week, and the technology sector led losses, with the tech index 2.4% lower Friday and plunging 5% over the week. Country Garden, which was formerly China's largest developer by sales, saw its stock fall below $1 Hong Kong dollar for the first time since it was listed in Hong Kong in 2007. Country Garden shares plunged 5.8% Friday to close at a record low of 98 Hong Kong cents, and since July the 28th the shares have plummeted 42%. The private home builder warned in an exchange filing late on Thursday of a net loss of $6.2 billion to $7.6 billion in the first half. On Saturday night, Country Garden said it will suspend trading in nearly a dozen onshore bonds starting today. And Yang Huyan, who is Country Garden's chairwoman, said in a statement on Friday night, "We're facing the biggest challenges since our establishment. Although the company has made every effort to rescue itself, the overall operational pressure on the company has only increased." And that looks set to pressurise the Hang Seng at the open this morning. Futures markets are pointing to a loss of 240 points, or 1.3%. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
At the start of a new week, it's time to welcome our guests. Our regular Monday morning commentator is Alex Wong, director of Alex KY Wong Asset Management. Morning to you, Alex.
Good morning, Peter.
And joining us this morning is Lashar, Asia Chief Economist from BBVA. Morning, Shark.
Morning, Peter.
Well, we've had more economic data out from China on Friday to go with the inflation data and the trade data we had earlier in the week. New lending by Chinese banks fell sharply in July to levels not seen since November 2009. Chinese banks extended 345.9 billion yuan in new yuan loans in July. That's about $48 billion US. But it was well below analyst forecasts of 800 billion yuan, and it was also a sharp drop from 679 billion yuan a year earlier and 3.05 trillion yuan in June, which was also followed a record 15.73 trillion yuan of loans in the first half of the year. Household loans, mostly mortgages, were down by 200 billion yuan during the month, compared with 963 billion yuan in the previous in June, and property owners have rushed to pay off their mortgages early instead of spending on shopping or other consumption. Meanwhile, outstanding yuan loans rose 11.1% in July. That's the slowest so far this year. And broad M2 money supply growth fell to 10.7% from 11.3% in June and below forecasts of 11%. Alex and Shark, what are you taking away from this? Following also, obviously, that deflation data and trade data we had last week, which was pretty grim, wasn't it?
Yes, I think overall we can see that Chinese economy now met some troubles. And if you look at this credit data growth is not as high as expected, I have to say there's some seasonality problem because July is the starting month of the second half of the year. So sometimes the banks, they all lend out a lot of things in June because they want to meet this half-year target, and then at the beginning of the second year, and then this kind of credit can slow down. It's normal, but this time, if you look at the pace of this credit slowdown, it's much higher than we expected. So that means the demand for credit is very weak. You already mentioned these mortgagers, they don't want to buy a house, but rather they pay off their existing mortgage. At the same time, even the firms, they have no appetite for further borrowing because they worry about the future. They think they don't have enough confidence for the economic outlook. As we see this import-export data very weak, the inflation data are very weak. I think that all this one, they are affecting people and the firms' behaviors because now they already have a very vulnerable confidence. So if this kind of things are continued, I'm afraid this growth will slow down further. So I think it's very important for authority to do something.
And what should they do?
I think they already announced the plan. Okay, they said we are going to boost people's confidence. We are going to boost the consumption. We are going to boost this public spending. We are going to boost the infrastructure construction. We are going to boost the property market. But what they have been materialized, I mean, on the side of the policy initiatives, we haven't seen a lot. Maybe now the authority, they are in their summer holidays in Beidaihe or anywhere. They are discussing about this detail, but I think they need to move fast. Yeah.
I mean, Alex, when we've talked the last couple of weeks about the Chinese economy, you haven't been that very optimistic. In fact, you've probably been quite pessimistic, haven't you, about the Chinese economy? What does this do? Does this make you even more pessimistic, this lack of demand in the economy for credit from businesses and private individuals?
I think I have been pessimistic toward the old economy parts, but a little bit optimistic towards the new economy part. So it's still the same. I think, first of all, the loan growth probably would remain weak because this is very difficult to do a lot of leverage if you want to transform the economy. Because if you want to lend, probably you need collaterals. But for the new economy part, actually, they cannot offer too much collaterals for you to do so. And I think the manufacturing business and also the property sector in China would not recover. So it is very likely to see weak demands from those asset-heavy sectors. So this probably would be a little bit transformational, I think. So we are not going back to the leveraging kind of doing business. So probably we need to boost confidence towards investors because if you want to expand the new economy part, probably you need something like venture capital. So you need confidence from investors rather than you need collaterals or you need some old kind of methods to do leverage. I think this is somewhat the authorities need to address because in the meantime, I think we probably may not see recovery in the manufacturing or the public sector soon.
I mean, if you want to improve that sentiment, it's not an easy thing to do, is it, really? But I'm wondering, one of the problems on the mainland is so many regulations and things that are in the way of actually sort of doing business. If they were to maybe signal easing some of those regulations, would that help improve sentiment?
Yeah, that I think it would help. Actually, last week we have two crazy IPOs in China Asia market already. So we are seeing the price from $5 to shoot up to 200 in 2-3 days. So that kind of speculations, actually, I think is some silver lining, because that is allowed, and I think it shows that some speculative activities in the stock market already. So I think generally it is difficult, but probably they need to do some examples first. So probably they should probably address Alibaba and Tencent and probably let them do their business.
I mean, Shark, one of the problems the PBOC has at the moment is the weak yuan, isn't it? Because if it takes too aggressive an action to cut interest rates or to cut the RRR, it's only going to send the currency even lower.
Yeah, that's true. I think now this kind of currency consideration is one of the constraints for PBOC, because in China, if you look at the currency, they always move with these economic fundamentals, and they also have a very significant impact on their stock market. Okay, usually when Chinese yuan become weaker, and you will see the stock market will be down as well. So that's why the PBOC, they are very cautious to move their interest rate, so that they don't want their currency have a big depreciation, and then they will have this chain effect. You will have troubles in domestic equity market. So that's why they're very careful. But now I think they start to move. Now I heard news that they encourage these banks to extend the more favorable rates to these mortgagors, and they also discussing maybe banks can lower their charge on this existing mortgage. Before this one is fixed, but now they want to lower that part. I think that they will do that one. But at the same time, I think in China, if you look at these authorities, the monetary authority and the fiscal authority, in fact, they all report to the same boss. Okay, so on the positive side, they can arrange this one. They can ensure their policy will in coordination with each other. But sometimes they also have the problem. Maybe the monetary policy makers, they want the fiscal policy maker to do more, and they have this kind of internal things. But anyway, I think now it's time for them to coordinate and make very swift actions.
Alex, how low can the yuan go, do you think? I mean, can they afford to let it slide much more? And what's the impact also going to be on stocks of a weak yuan?
I think the yuan actually would go further lower, probably towards 7.5 and eventually 8, I think. But the pace of the depreciation actually would be slow, I think, because they know that the yuan rate is important for business decisions. But if they fall slowly, then people would adjust their expectations and probably would be more safeguard against this depreciation. So I think the rate of depreciation would be very slow. But we will see a weaker one eventually, because the weight differential actually is negative for one. So this negative factor, I think, will persist. So, but I don't think a lot of people would do the carry trade. So very likely we would see a weaker one, but the depreciation rates, I think, would be much slower than expected. So probably by the end of 2024, we would see a much weaker one, but the depreciation actually would not be that sharp. We are not expecting 7.5 next week or something like $8 this year. And so very likely we would see a gradual process. So people can adjust their expectations and adjust their financial positions to cater for that kind of depreciation.
But if investors ultimately take the view that, albeit slowly, the yuan is going to slide to 8, what does that mean for stocks? It doesn't seem that attractive for Chinese stocks.
I think that would be bad for those companies which are doing domestic business and have a huge cash flow from locally, like the more telecom sectors. I think people are a little bit counted in that sector right now because they are defensive, but a weaker one actually would be negative for that sector. So I think if you want to buy China, they just buy those larger mega techs because they probably have some room to improve. But for those defensive sectors which are generating a huge cash flows from locally, I think they probably would be affected by this weak one.
Which is a lot of Hang Seng companies, isn't it? So quite a few of them are generating their profits on the mainland. So presumably that's not good news for Hong Kong stocks.
Yeah, not good news for Hong Kong stocks. I think in Hong Kong right now, people are just confident towards a few sectors, probably HSBC, the oil sectors, and the telecom sectors right now. So there are only those one left in the Hang Seng Index, which are having some support. I think we probably would expect the Hang Seng to range for a while, but the bias is still on the downside because right now even the local property sectors is getting a hit. So I think we probably may see a weak Hang Seng Index, but if we see a rebound, I think that it would be led by the megatech.
Shark, what do you think about the Hong Kong economy? We've seen the revision down now in the growth forecast by the Hong Kong government from to 4 to 5%. We saw the second quarter GDP confirmed at 1.9%. Paul Chan was saying that a lot of the economy is still going to depend upon tourism and domestic consumption, but we need to change our tourism offering to attract more people to come to Hong Kong. We were talking earlier before the show about how many Hong Kong people are going to Shenzhen for the weekend these days. What's your thoughts?
Yes, exactly. If you look at some sectors in Hong Kong, I think they are still under great pressures. Initially, we expect this reopening of the Chinese economy will have more Chinese tourists coming to Hong Kong. But in the end, we find more Hong Kong people, they go to Shenzhen, to consume there. So that's why our tourism sector doesn't perform very good. And if Alex is right, this yuan will go to 8 one day, I'm afraid that more people will go to Shenzhen, right?
Yes.
Yeah. So, but that's only one part of the story. But if you look at bigger part, if you look at this IPO performance in Tong, I think in Hong Kong we didn't have a lot of the IPO early this year. The same things also happened to re-export sectors, because in the past we re-export a lot of things to other countries, from China to other countries. But nowadays you can see from the second quarter, this export sector in China, they slow down. It also affect the re-export sectors here in Hong Kong. So all this story pieced together, we find this second quarter GDP doesn't perform very good.
Where's our growth going to come from? I mean, I noticed I was out over the weekend, and on Saturday night, night, one of the restaurants that I sort of regularly go to, it was virtually empty for a Saturday night, which used to be sort of unheard of, really, sort of pre-pandemic times. But it seems that, you know, the local consumer just isn't consuming at the moment.
Yes, that's true. I think this still the Hong Kong is a consumption-based economy. If you look at the percentage of the consumption to total GDP in Hong Kong, is very, very high, much higher than in China. So I think in future, if you want to stimulate the economy, of course, you need to improve your tourist sectors. You need to attract more tourists, not only from China, but also from other places. Okay, Hong Kong should become more open, more welcome to the tourists outside. At the same time, I think that on the financial sectors, okay, you need to attract more IPOs, but I know it's very hard for the moment, but definitely you need to find a new growth point. And now I noticed that Hong Kong Monetary Authority, they want to develop this virtual asset.
So, Alex, how do we get more IPOs coming to the city? Because it's a difficult thing, isn't it? I mean, do we need to make it easier for companies to list here? What's the solution?
Oh, I think it's very difficult. Right now, we are having a lousy time to get privatized. So another foreign company is going out. So I think right now it's in a vicious cycle because our turnover is extremely slow, and then the sentiment is quite bad. So I think people probably would choose US or even UK over us. So I think it's quite difficult. I think you have to probably source more companies from Southeast Asia first, probably, because right now we are too reliant on China. Probably we could be still attractive towards Southeast Asian companies. So I think that probably in source. So this is very difficult right now because the turnover is so slow and the sentiment is so bad. I think we probably may not have too much to do.
There's been talk many times over the years about Hong Kong being a hub for non-Chinese companies, for companies, international companies that do business in the region to come and list in Hong Kong, but it's just never really happened, has it?
Yeah, because the positioning of Hong Kong stock market is a very, very difficult to define. I think right now we are not being a new economy stock market, or we are not being international stock market or a resources stock market. I think we are having a very clear positioning of the stock market right now in Hong Kong.
So where does our economic growth come from over the coming sort of the rest of the year?
I think it's very difficult to grow. Right now, we are having a very bad financial market, very low turnover, and very bad property market right now. So local consumers actually are in very bad mood, and then we are not easy to attract a lot of tourists because the price level here is not low. So I think it's quite difficult to do.
Shark, do you worry about the mainland slipping into deflation and what that could mean, both for the mainland and also for here in Hong Kong as well?
Yeah, I think if you look at inflation, it's true that now they have negative growth on CPI. But I don't worry too much about this deflation problem because now the Chinese problem is a lack of confidence. There's a growth problem. I think that we don't need to worry too much about this price level things. We need to focus on the growth side. You must find ways to stimulate the growth because if you look at the Chinese potential growth rate, I like to say if there's nothing happened, I think that China can manage to grow by 6 to even 7%.
I mean,
because now it's in the recovery period. That's why we tend to have a higher estimate for that one. But now I think the growth may be only 4%. I mean, in the second half of the year, only around 4% or 4.5%. That means that there's still huge gap between the potential level and the real level. So that means you need to do something. I always favor to do more and to do swiftly. Yeah.
I mean, I'm wondering, though, if people are getting worried about deflation just as actually maybe deflation has sort of reached a bottom, because a lot of that deflation came from food prices, didn't it? Which is a sort of more of a temporary effect. And if you look month on month, inflation's actually increasing.
Yeah, exactly. And also, if you look at some sectors like tourism sector, accommodation sectors, their price increased quite a lot. In summer, people travel quite a lot in China because this shows some people describe this situation as a two-speed recovery. On one hand, you can see this service sector is booming in China, but at the same time, if you look at the property market problem, if you look at the manufacturing sector, I think their growth are quite staggering. Yeah.
Let's move on to Country Garden, Alex. I mean, this is the big news, really, of the weekend, isn't it? It was formerly China's largest developer by sales. I think it's about number 5 or 6 now, but its stock has fallen below $1 Hong Kong for the first time ever. So it's basically become a penny stock. It was trading at 98 cents on Friday. Also, it's now being reported that Country Garden are going to suspend trading in 10 of its domestic bonds in Shanghai and Shenzhen starting today. Country Garden's chairwoman said we're facing the biggest challenges since our establishment. Although the company has made every effort to rescue itself, the overall operational pressure on the company has only increased. It's reporting a first half net loss of between $6.2 billion and $7.6 billion. I mean, Alex, this is staggering amounts, isn't it? I mean, is it on the verge of default, do you think?
I think probably yes. Or at least they would need to restructure their loans. So probably they need to stretch the repayment periods and also do some haircuts eventually. So I think that this is, but the news actually is not unexpected. So people know that Country Garden is in trouble. But I think the confidence actually is hurt quite a lot because Country Garden has been one of the better one among those private enterprises in China in the property sector. So the failure of Country Garden actually is a further example that we probably may not see recovery in the property sector. So very likely, I think we would continue to see the old economy park in the China to go down.
I mean, the government has indicated it's not prepared to step in and bail out these developers. It's let Evergrande default. Can it afford to do the same with Country Garden and just let it default?
I think it will let it default because I think the advantage of saving it will not be too much because the hole is too huge. Probably you have to put too much money to save it, and then you do not have too many advantages to get. So I think they will let it default, and probably we would see the property sector to go down further because people expect those kind of developers would be in trouble, and they probably would be worried about their delivery of flats. So I think this is a vicious cycle.
I mean, Alex, Shark, what does it mean for local people? I would have thought it puts them off when buying property from these private developers. If anything, it would drive them towards the state-owned developers rather than dealing with the private ones and running the risk of not getting their property delivered.
I think you're right. I think that for these local people, now they are become increasingly reluctant to buy houses. And maybe the government, they believe that if this private developer have problem, maybe this kind of purchasing power will go to the state-owned developer. But the thing is, if you look at the figure, I'm afraid it didn't happen. The problem is when people become worried about the developers, they worry about all of them. So because it's like a domino.
You don't distinguish, do you? You
exactly,
see them all as
one by
bad.
one, from the Evergrande and now to this Country Garden, and then to. I think the authorities, they should do something. Although so far they haven't done anything to save this. Country Garden, but Country Garden is, as Alex said, is different from Evergrande. It's good developers, and the main portfolio of the company, they are in these property sectors.
But it's in the third and fourth tier cities, isn't it, which have been hit hard by the downturn.
Exactly. So that means authorities, if you can, they can offer some guarantee, offer some. They don't need to offer a lot of the money. They just
guarantee what?
Guarantee for their debt, for their bond payment, something like that. They prolong these kind of things, even in the process of their restructuring of their debt. I think the government, they can step in to help them to stabilize people's expectation. I think it's very important for them to do something. Otherwise, I'm afraid that the sentiment of this property market will become much worse than before. This could prolong the crisis in the property sector.
But Country Garden has about $200 billion worth of debt, and in many ways it could be even worse than Evergrande because it has about 4 times as many projects as Evergrande. In effect, it can't possibly repay $200 billion in the current climate, and it's got coupon payments every single month of this year. It's technically, it's insolvent, isn't it?
I think that if you think about this layman case, if you prolong the process of the liquidation, we find that layman didn't default at that time. They default, but they didn't in insolvency status during that time, because when they recover all the assets of the Lehman Brothers, in fact, they make some money. I think the case for Country Garden should be quite similar. The government, they can prolong the process because now the market climate, we know that it's not right. It's not a proper one. But if you given time to these developers, in the long run, maybe they can come back. But for the short term, they shouldn't allow this liquidity problem into this solvency problem.
So is this China's Lehman's moments now where it's got to really step in and make a decision?
To some degree, it's not financial enterprises, but at the same time, if you look at its impact on Chinese economy, impact on China's financial system, I'm afraid this one is comparable to Lehman.
What do you think, Alex? Comparable?
I think it's comparable. I'm actually quite a bit surprising that the market actually is so calm right now. We are not having a very big stock crash. I think the government actually did a quick job in slowing the decline, but I think the eventual direction actually is still down for the whole economy part of China. I think what they can do is just to help those private enterprises to boost investors' confidence. So the property market actually is dead. I think that is a structural problem that cannot be solved. So nothing that much they can do, I think. And I think the advice for me is avoid all property-related investments in China.
And so presumably, what's the impact going to be, do you think, on the markets? Because futures are looking very weak this morning following this news of Country Garden. Do you think maybe finally investors are going to sit up and take notice?
I think probably the decline would still be a little bit slow because we are not seeing that Lehman kind of a collapse in China right now. We are seeing a very gradual decline and very hopeless kind of a trend right now. So I don't think people would be very bearish to sell everything at once. So I think this process actually will take some time because people are still hoping for some sort of policy support from somewhere. And that is slowing the decline. So I think this probably would still be the case. So we probably may see the market to trend lower, but the pace of the decline may not be as fast as we have seen a decade ago.
And could it still remain like that if Country Garden defaults?
Yeah, credit market actually is very bad. We have already seen this Lehman kind of crash in the credit market last year. And this year, this Country Garden actually is just another case which is not hurting too much because we probably have already expected that kind of case to repeat again. So the credit market will remain bad in China. Those are high yield companies. I think even those local government bonds would be bad. And China is not like U.S. People have not too much confidence towards the government credibility to repay it, I think. So that's why the whole credit situation will still be quite bad.
Shark, final word to you. It does feel like, based upon what we've been talking about this morning and what we've been seeing, we're sort of getting to a crucial point now for China's economy. It slipped into deflation. The trade data was awful. The loan data was bad. And now on top of that, we've got a worsening property market and a potential default from China's largest property developer. It seems, that things are coming together and not in a good way.
I think you are right. Now the situation is very intense. So that's why I'm calling the authorities to move very fast. I think they still have this time window do something to reverse the people's sentiment. They can do a lot of things. The jury is still out. I can now say that the Chinese economy will doomed to be to become very bad. But the problem is, if they don't do the right thing at the right time, I'm afraid that we need more time to recover what we have now. Yeah.
Okay, well, thank you both very much. Good to hear your thoughts this morning. That's Lashar, who is Asia Chief Economist from BBVA. Alex Wong, who is Director of Alex K.Y. Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Shanghai-based independent economist Andy Scher. Morning, Andy.
Good morning, Peter.
I'm getting the feeling that we're entering a sort of a crucial period for China's economy. We've seen a lot of data over the last few days, haven't we? Most of which was not good. Chinese economy slipping into deflation. The trade data was bad. And then we had new bank lending falling to the lowest level since 2009. And now a worsening property sector as well. What's your assessment? Is the sort of Chinese economy sort of entering a crisis period?
Well, I think that China experienced a property bubble for a long time, and the bubble peaked a couple of years ago, and property developers got into trouble and not able to pay back their debts. So that's been hanging around for a long time, and then we have this global trade recession. These two things are coming together. On the property side. These guys have not been able to repay their debts and have been dragging on, and more companies are coming down their path. So it has obviously it has a big impact on the credit market and as well as the property sector as a whole. So I think the issue is that you piled up mistakes before. Now you have to pay. You have to pay for it through adjustment. Basically, the property developer should not be able to borrow more money, and that has an effect on the credit market. So these are things that the market needs to adjust. And it would be a mistake for the government to stimulate, to bail out these guys. And then you create a bigger problem. So you have to look at what's going on now from that angle. Then you say, hey, it's probably it's a good thing that the economy is experiencing bad news because that the mistakes have been corrected.
But is it getting worse in the property sector? Because if you look at Country Garden, which was China's biggest property developer, it's got about $200 billion of loans, which clearly it can't afford to repay unless it finds a way to refinance itself. And the refinancing it tried a week ago got suddenly cancelled. It's going to be on the verge of collapse, isn't it?
Yeah, but the issue of refinancing is refinancing. It's kind of financial guys like to talk about refinancing, but the issue is that if the underlying fundamental is not there, refinancing is just a Ponzi scheme, and it's been a Ponzi scheme. The property sector has been a Ponzi scheme for a long time.
So you're saying that the best thing to do is for the government to let these companies go under, not try and bail them out, just let them go under?
Yeah, just let the market adjust. The Chinese property sector is too big, and the price is too high. So the sector needs to shrink. The sector needs to shrink at least by 50%. At least by 50% in terms of volume.
By 50%.
In terms of volume, yeah. And in terms of price, like in big tier 1 cities, still trading at like 5 or 6 months of salary per square meter. It's not sustainable. So the price has to come down. You cannot say that when things are wrong, when they come down, the economy is not good. You can't say, hey, because the economy is not good, we have to stimulate and we have to make these things to go back up. So you're just making a bigger problem.
But if the property sector contracts by 50%, that's first of all going to have an enormous impact on confidence, isn't it, in the property sector overall. People are just not going to want to buy, certainly not from private developers under any circumstances, but presumably it would have enormous spillover effects on the overall economy as well.
Yeah, well, the first is that confidence. Confidence in what? Confidence in a property bubble, keeping it going, is that a good thing? I think that China had this conversation many times before and made the bubble bigger and bigger.
But
now the government is not going to do anything. Because there's no political imperative to do it. The government is just the same guy in charge, and there's no opposition.
So do you think?
So now it's time to do it.
So do you think the government then, they will sit on their hands? They're not going to do anything at all about this and just see what happens to these property developers?
Yeah, I think that the issue is the 20th Party Congress really was over, and the political transition has already occurred. It has already occurred. Yeah.
So what is your thoughts then about what this means for the economy overall? Let's suppose this happens. Let's suppose Country Garden defaults and the government doesn't step in. What is the impact going to be on the Chinese economy of that?
I think that the economy impact I wrote about it is that there is an impact, a traditional impact through like the construction materials and so forth. But that is not as big as people think. The property sales were between 15 to 20% of GDP for a period of time. But half of that is just land sales cost. It's a transfer payment from the developer to the local government. And then that money is from debt. So you basically, property developers borrow money to pay the government. So that is a big in half, and a lot of small city governments don't have the money to go on, so they cannot pay for their if they say civil servants or employees and so forth, and that is the adjustment they have to make because it means that their governments are too big.
So some of these local government financing vehicles, are they going to have to be bowed out by the central government? Because if we allow the property sector, if the government allows the property sector to contract by 50%, it's going to put enormous pressure on them and also on the banks as well.
Yeah, the issue is that obviously there's debt to be paid, but there also there's revenue. There's kind of expenditure to be cut. So that's the adjustment that needs to happen. So in the short term, there is a bad impact on the economy, and they have to cancel their investment projects, and they have to lay off people. But over time, it's good because these governments are not viable. They depend on a bubble to keep it going.
So you're in favour of just letting that bubble burst, and then presumably that's going to...
It is bursting already, and if you want to bail it back, we're talking about tens of trillions of RMB. And this government cannot afford it because politically there's no need for it to do that.
So are we reaching...
If there's bad news, so what?
Are we reaching a sort of Minsky moment now where this is all coming together and it's got to be dealt with now?
It's not a Minsky moment because in China the market doesn't work that way. There's no snowballing. If the developer cannot pay back, it doesn't pay.
Which is what we're seeing.
So the creditors don't have any rights.
Right.
They cannot just take over the company and liquidate it. You cannot do that. So there's no snowballing in China.
Although they could take their overseas assets, presumably, the assets they have in Hong Kong and elsewhere.
Not a lot. Not a lot.
So what does this mean then for demand in the economy? Because we've already seen, haven't we, China slipping into deflation. We saw that new loan data on Friday, which showed Chinese bank lending falling to the lowest level since November 2009, suggesting that really there's just completely insufficient demand in the economy. This will make that demand problem even worse, won't it?
Well, in the short term, you say that it's bad for the economic growth. But so what, right? People are paying off their debts early. Is that a good thing or a bad thing? So economists oftentimes have this contradiction that what sounds good in common sense is bad for the economy. But it's only bad in the short term. It's not like when you let the economy go down, it will keep going down. It's not like that. The market works, and once the excesses are being squeezed out, the economy will stabilize. And also, deflation is like the economists often say, "Oh, deflation, bad news, keep money cranking." It's the wrong way to look at that. And China had high prices for a long time, like from automobile, like everything made in China should be cheap. But why automobiles were more expensive in China than in developed markets? So and why bread in China is more expensive than anywhere else?
So you're saying.
So
what you're saying is very different from what most other economists are saying on the mainland. They're calling for stimulus. They're calling for the government to intervene to stop the economy slipping further into deflation. What you're really saying is that there'll be some short-term pain, but the economy will eventually readjust and sort itself out. And therefore, the government should refrain from doing those types of things.
Yeah, you look at the people who are saying, let's just crank up the money supply and just give more money to property developers so they can refinance, and then they keep on buying land. But as a basic business is a bubble, is a loss making, but it doesn't matter. You keep it rolling, right? It's snowballing, and this is basically creating a bigger and a bigger problem for yourself.
Okay,
that's why we're where we are now.
Okay, well, very interesting thoughts, Andy. It's always very good to hear your thoughts on these matters. That's Andy Scher, who is a Shanghai-based independent economist.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, Will Denyer, US economist at Gavacal, and Tony Nash, founder of Complete Intelligence. Bye for now.
Money Talk